How's everybody doing? Welcome back to another episode of the Banker Next Door. I am your host, Dr. Joe Berquist. This is the weekly banking update, the main show of the channel. I thank you so much for just tuning in to check this out. This is where I go for 30 minutes and basically try to give you a whole roundup of the news that is happening this week in the wonderful world of banking. But before I get started, before I jump in, I just wanted to talk about a couple of the other episodes that I shot for this weekend. So I had my latest update, kind of a second conversation with Alan Berkeley, and I'm hoping to make these kind of conversations a little bit regular in nature. Hoping to do maybe try to do something like every month where they come in. So I did a new new conversation with Alan where we talked about a range of topics that include basically the Federal Reserve holds rates steady. We talked about Saudi Arabia and the effects on the petrodollar. We talked about how all of that could basically affect the treasuries market. We talked about the Synapse bankruptcy, the push for open banking from the CFPB. We talked about BOI with an update there, and I'm going to give you a bigger update on that here in a minute. And then we kind of closed out with just talking about the cultural issues at the FDIC. So I thought it was a really good conversation there I had with Alan. So please check that episode out. And if you missed the first conversation that I did with Alan, I did put a link to that episode into the description link there for the current episode. So that way, if you want to go back and listen to the first one we did, you can go back and do that. But like I said, I'm hoping to make those conversations with Alan a little bit more frequent, and definitely got some other interviews and some other things coming up here in the next month. Also, I did a review of Bank Director put out their 2024 compensation and talent survey. So I did a review of that. It had some very kind of interesting findings there on that one if you want to go check that out. And then I also put up an episode about banks and their focus on short-term funding right now. Like, banks are basically positioning themselves for rate cuts, and so therefore they're putting more emphasis on short-term depository funding. So in other words, 6 to 12 month CDs, premium money market accounts. That would be money market accounts that have balances probably up to or over $250,000. And so I took a look at that, basically just, what are banks focusing on there with the CD range. I talked a little bit about how the rates had hit 5% in the fourth quarter of 2023, but have now kind of come down a little bit and have settled in the 4% range on a lot of those CD and CD and money market products. So check out those episodes if you have a chance. Also, check out some of the other episodes. I did a really interesting one on Noku Bank last week and how they decided to basically sell $63 billion in U.S. government treasuries. I also did an episode on the Synapse bankruptcy if you're interested in learning about that. But I would also tell everybody, go check out some of the other content on the channel. There's a number of interviews that are up there. I also did an entire series on the book called The Lords of Easy Money, which was has been a hugely popular series. A lot of people have really liked and enjoyed that. So I would tell you to go and check that out if you've not already seen that. I've also got a number of kind of books, book reviews. I've got movie and other business related documentary reviews. And then I also have the crypto series, which is out there. So go and check out some of these things. And I hope you will enjoy all that content. So now, that being said, let's get into the news. And let's start in here with this. So the Federal Reserve's annual stress test results showed that while large banks would endure greater losses than last year's tests, they were well positioned to weather a severe recession and stay above minimum capital requirements. Projected losses increased at the vast majority of the 31 large banks in this year's stress test relative to their most recent previous assessments and are likely to translate into higher capital requirements. For the banks in the aggregate, the Common Equity Tier 1 CET1 ratio fell by a maximum of 2.8% in the simulation, compared with 2.5% in 2023 and 2.7% in 2022. The Fed said the stress scenario used this year is about the same as last year, and that the higher losses reflect rapid growth in credit card loans and a deterioration of credit performance in those portfolios. Growing risk in corporate portfolios reflected in the bank's own ratings of their loans, and a recent decline in non-interest net revenue that carries into projections of bank earnings that are available to absorb credit losses. And then following on that, JP Morgan and Chase commented on the February's 2024 stress test results, stating that compared to its own assessment, the Fed's projections for the benefit in the bank's other comprehensive income appear to be too large. Should the firm's analysis be correct, the resulting stress losses would be modestly higher than those disclosed by the Federal Reserve, the bank said in a June 26 statement. So JP Morgan is basically saying there that they felt that, I guess, the stress test was maybe taking a little bit easier on them than they should have, and that by their calculations, the losses would be somewhat slightly larger. So just kind of interesting to note there. Martinsville, Virginia-based Carter Bancshares said in a June 26 regulatory filing that the lawsuit filed against its subsidiary, Carter Bank and Trust, and its board of directors by West Virginia Governor James Justice II and family and various related entities that he and they owned have been voluntarily dismissed with prejudice. This means that the plaintiffs waive any claim and may not bring any future legal action in any court against Carter Bank based on the facts alleged in the federal lawsuit. That's interesting because that's a case that's been going on for a while. Evolve Bancorp's unit, Evolve Bank and Trust, reported a cybersecurity incident potentially affecting certain personal information of its customers. The bank on its website said it is looking into the incident, which involved a known cyber criminal organization. The group seemed to have illegally obtained data and personal information of some of the bank's customers and released them on the dark web, according to the bank. Now, I wonder, obviously Evolve got wrapped up in the whole Synapse bankruptcy, and obviously there's a lot of customers' money that they can't get to there. It's, again, tough to say that one thing may be related to the other, but maybe. Okay, Citigroup has urged employees not to be drawn into altercations with protesters outside the bank's New York headquarters, Bloomberg News reported, citing a memo to staff seen by the news outlet. The bank is facing climate and pro-Palestinian protesters who have blocked the entrance to the bank's main office in recent weeks, the report said. That doesn't sound too good. A technical glitch at the New York Stock Exchange earlier this month that led to odd trades displaying share price drops of 99% for some companies resulted in approximately $48 million in losses for Interactive Brokers Group, Inc. So Interactive Brokers is considering its options to recover the money, including possible legal action. San Francisco-based banking technologies firm Chime Financial agreed to acquire enterprise technology firm Salt Labs, Inc. Under the agreement, the Salt Labs team, led by Jason Lee, probably not the actor, and the company's offerings will become a part of Chime. Transaction details were undisclosed. A report from the Office of the Comptroller of the Currency showed that 97.4% of first lien mortgages were current and performing at the end of the first quarter, an increase from the 97.2% in the 2020-23 fourth quarter, and a decrease from the 97.6% from the year ago period. The agency also reported a quarter-over-quarter decline in the percentage of seriously delinquent mortgages in the first quarter, a continuation of the downward trend since the 2020-22 first quarter. So that's just basically saying that first mortgage lien positions are in pretty good shape right now. Okay, apart from the three credit reporting bureaus, Equifax, Experian, and TransUnion, more financial institutions are facing increased consumer lawsuits for alleged errors in credit reporting, particularly encouraged by the Consumer Financial Protection Bureau's regulatory crackdown on credit bureaus and data furnishers, and a growing number of social media posts from credit repair firms. It's kind of interesting. Okay, U.S. District Judge Margot Brody in New York formally rejected a $30 billion settlement between Visa, MasterCard, and retailers to cap credit card swipe fees, Bloomberg News reported. The settlement, which some merchant groups deemed a bad deal, would have allowed retailers to charge consumers extra in transactions involving Visa or MasterCard credit cards, and let merchants steer consumers to lower cost cards via pricing tactics, according to the report. So that's kind of interesting. We'll have to keep an eye on that. Banks are using new types of tools to finance renewable energy projects as they regain a share of the debt deal-making flow lost to private credit funds. A new kind of deal structure is also emerging as banks provide loans to private equity-owned projects and are paid back in tax credit sale proceeds. Bankrupt cryptocurrency exchange FTX Trading will poll customers and creditors in the coming weeks on the firm's multi-billion-dollar plan for paying victims whose assets are locked on the collapsed platform. Bloomberg News reported, citing a June 25th hearing in a Delaware bankruptcy court. The Internal Revenue Service apologized to Citadel founder Ken Griffin for the leak of the billionaire's investors' confidential data, which were disclosed to news outlet ProPublica and consequently published in articles from June 2021, the Wall Street Journal reported. According to the report, Griffin was among the wealthy taxpayers, including Jeff Bezos and Elon Musk, whose tax records were leaked by IRS contractor Charles Littlejohn to the news outlet. They apologized to Ken Griffin. I'm going to have to, I need to dwell on that one. That's going to sit with me for a while here. The Consumer Financial Protection Bureau issued an internal final rule extending compliance deadlines for its March 2023 small business lending rule, which the federal court in Texas stayed last year pending the Supreme Court's decision on the legality of the CFPB's funding. The compliance dates are extended by 290 days to compensate for the period the rule was stayed, according to a press release. So, yes, so I've reported on that. That is called the 1071, which is part of the Dodd-Frank Act, which is basically forces banks to collect more data points on small business customers. And so that will be fun when that kicks in eventually. Ransomware group Lockbit claimed it had stolen 33 terabytes of data belonging to the Federal Reserve, threatening to spill them, American Banker reported, citing a post on the group's victim shaming site. Threat analysts said the hackers' claim was likely a lie, according to the report. So that will be very, very interesting to keep an eye on. The U.S. Securities and Exchange Commission is assessing its next steps to force hedge funds and private equity firms to disclose more about their fees after a New Orleans appeals court blocked the regulator's rules, saying it overstepped its authority. Bloomberg News reported, citing an interview with SEC Chair Gary Gensler. The Commodity Futures Trading Commission approved final capital comparability determinations for certain non-U.S. non-bank swap dealers. In a press release, the agency said it has approved comparability orders granting conditional substituted compliance related to its capital and financial reporting requirements for registered swap dealers based in Japan, Mexico, France, Germany, and the UK. Oof, that was a mouthful. Okay. A 3-page document shown by the Federal Reserve to other U.S. regulators indicates a watered-down version of the proposed bank capital rules, including parts related to the assessment of risk tied to banks' trading, wealth management, and investment banking activities, Bloomberg News reported, citing people familiar with the matter. The Fed document does not indicate an updated estimate on the proposed increase in bank capital requirements, but unnamed sources said the required increase could be as low as 5% from the originally proposed 16% hike, the report said. So, yeah, I mean, undoubtedly, there's a lot of fighting, a lot of pressing back and forth on what should or shouldn't be there. So, that will, I think the next couple months, there will be a lot more details or information coming out on that. Big U.S. banks are expected to be cautious on investor payouts in light of the Federal Reserve's upcoming announcement of the results of its annual stress test as they seek to boost their case against the regulator's proposed capital rules. Reuters reports, analysts saying, so the stress test could be used as a proxy battle in the overall capital regulatory reform war. Well, obviously, I just reported on the results of the capital stress test, and they actually weren't too bad. So I don't think that that's going to give the Fed any more leverage to increase the capital if they just did the stress test and they weren't really that bad. The Federal Housing Finance Agency issued conditional approval for Freddie Mac to engage in a limited pilot to purchase certain single-family closed-end second mortgages. The approval includes several limitations on the product, including a maximum volume of $2.5 billion in mortgages and a maximum duration of 18 months. The Office of the Comptroller of the Currency requested comment on a proposal to revise its recovery planning guidelines for certain large insured national banks, federal savings associations, and federal branches. The proposed revision would require the guidelines to apply to banks with at least $100 billion in assets and incorporate a testing standard for recovery plans. So, okay, there you go. Now, normally I talk about kind of the economic indicators that are going to be coming out in the following week. I apologize. I do not have that list here this week with me, but next week is the 4th of July holiday week. So it's going to be a very quiet week. I would expect, banks will be closed on Thursday. I would expect Friday will probably be a very quiet day. So I can't imagine that there's a whole lot coming out then. So I'll be back when I come back next week. I'll update with more information on that. And I do have a few tidbits here before we're done. So I wanted to share this with everybody. So I sat in on a webinar where the head of the National Small Business Association, who is Todd McCracken, he sat in and he gave an update on BOI, beneficial ownership information. This is something I've reported on. If you have not seen my beneficial ownership information episode, please go back and look that up. It's very important. So what happened? So the NSBA, they filed a lawsuit in 2022, and in March 1st of 2024, they shockingly to some won the case. Congress, basically, they found that in the court that basically Congress has no power to enforce the act and basically the BOI that is being enforced by the FinCEN and FFIEC right now. So basically, the Department of Justice, the DOJ, they appealed this decision to a higher court. Now, arguments will be heard in September with a ruling coming shortly thereafter. So as of right now, only members at the NSBA at the date of the ruling. So as of March, so if you had to be a member on March 1st or before March 1st, so they are covered right now. So basically, they don't have any requirement to report right now. But despite this ruling, the FFIEC has continued to move forward with the rollout and the implementation of BOI. We also have 21 attorney generals have filed amicus briefs on behalf of the NSBA. And they have also noted, they've also made a case for the urgency of the timing of the case, considering that if you had a company or formed a company before 2024, you will have to start reporting on that on January 1st, 2025. You will have to comply and you will have to basically sign up and fill out your BOI forms and information. They did want to say that basically they wanted to point out that basically the penalties are horrendous. That basically you could face up to 2 years in prison and a $10,000 fine. And basically anything that changes, if you change your address, if you have to renew a driver's license, basically you have 30 days to then go in and update those forms. Otherwise, they could basically go after you and hit you with these fines and these penalties, which is absurd. And that's one of the reasons why I'm highly against this, because I think these fees and penalties are just absolutely ridiculous. Congress did pass legislation that would delay the implementation of this by 1 year, but that legislation is currently sitting in the Senate. No surprise there, and probably nothing, given the circumstances, election year, everything else, probably nothing really going to happen with that. And let's see here. They just go on to say, you could contact your senators to ask them to look into this, try to do something about it, try to pass that legislation. And then obviously there's a lot of hubbub around what is the actual definition of a beneficial owner, because that is very vague. Technically, if you have your accountant fill out the forms for you, or you have your lawyer fill out the forms for you, they could be considered a beneficial owner, because they're helping you and advising you on what you're doing with your business. And again, this is where this whole thing gets crazy. NSBA, they do have a frequently asked questions list on their website. So I would tell everybody to go check that out if you're looking for more information. And like I said, so that's that. And I will continue to keep people updated on that. So let's get into some other news and stuff here real quick before we get out of here. So GM withdraws their ILC charter application. So General Motors withdrew its application after suspending its bid to form an industrial loan company. GM said the Utah Department of Financial Institutions this month approved its application to form GM Financial Bank, which the automaker filed in December of 2020. GM said it would refile with the FDIC and the UDFI. So kind of interesting. Keep an eye on that. ICBA and others have proposed a data privacy bill ahead of a markup. So ICBA and other groups expressed opposition to legislation that would establish a national data privacy standard. So the American Privacy Rights Act, which the House Energy and Commerce Committee is scheduled to mark up today, would preempt many state data security laws, but does not include clear language exempting financial institutions subject to Gramm-Leach-Bliley Act data security standards. So, basically, the group said the bill fails to address previous concerns raised before a subcommittee markup last month, so they oppose the legislation. So interesting there. FDIC adds summary of deposits to Bank Find Suite. So the FDIC is adding the summary of deposits to the Bank Find Suite, a resource for consumers, researchers, and analysts to understand financial details and trends among FDIC insured banks. The new SOD site is available to preview now. The modernized site will be completed by the end of this year. The legacy summary of deposits application will be discontinued, and users will be automatically redirected to the Bank Find Suite. So I will be checking that out, and I'll do an episode on that just to show everybody the new website and what's going on with that. So some economic data. So new home sales dropped in May. So sales of new single-family homes fell 11.3% in May and are now down 16.2% from the previous year. The Commerce Department reported the median sales price for the month was $417,000, down from April. So that's a pretty steep drop on new home sales. Basically 11.3% in May, and this is usually one of the best sales months of the year, and are now down 16.2% from last year, so which is not good. So the Fed's Bowman recommended Basel III endgame changes. So Federal Reserve Governor Michelle Bowman said she sees a path forward for implementing proposed Basel III endgame capital rules that addresses concerns with their effectiveness and efficiency. So, all right. It's good to know. CFPB extends compliance dates for the 1071 rule. We talked about that. Bank trading revenues rises in the first quarter as per the OCC. So the OCC reported cumulative trading revenue at U.S. commercial banks and savings associations of $15.6 billion in the first quarter, up 34.2% from the previous quarter, but down 11.1% from a year earlier. Home prices rise and consumer confidence weakens. So home prices saw an annual gain of 6.3% in April, slightly below the March gain. The Federal Housing Finance Agency's index of house prices rose 0.2% in April from the prior month and was up 6.3% from a year ago. The Consumer Confidence Index declined in June to 100.4 from 101.3 in May. Commonwealth University of Pennsylvania wins the CSBS Community Bank Competition. So the Conference of State Bank Supervisors named a student team from the Commonwealth University of Pennsylvania as the winner of the 2024 Community Bank Case Study Competition. Teams from the University of Illinois Springfield and Southeastern Louisiana University placed second and third, respectively. So this year, 27 student teams representing 21 colleges and universities entered the competition. The teams partnered with local community banks to learn about how they handle risk through assets and liability management after last year's regional bank closures. The top three case studies will be published in the CSBS Journal of Community Bank Case Studies in October. Well, congratulations to the Commonwealth University of Pennsylvania. That, I think, is a pretty awesome thing right there. ICBA opposes Freddie Mac pilot to purchase second mortgages. So ICBA announced its opposition to the Federal Housing Finance Agency's conditional approval of Freddie Mac's proposal to engage in a pilot program to purchase certain single-family closed-end second mortgages. So like I said, I reported that they did get approval for that pilot program, but the ICBA is coming out and basically saying not going to happen. They don't, or at least they don't want it to happen. Okay, so Treasury announces push to lower housing costs. Yeah, that's not really going to do much. ICBA opposes approval of new industrial loan company. What else is new? Fed issues ICBA requested extension on FedWire comment period. And what else do we have here? All right. And okay, so let's go in. I want to hit a couple of things real quick. So Bank of Marin sells $293 million in available for sale securities. So basically, they were looking. They sold these securities and basically looking to reposition their balance sheet. So again, seeing banks. If you saw the episode I did last week on the situation and unrealized losses in banks' bond portfolios, you can basically go out and get some more information on that. But just wanted to show that some of the banks out there are still, selling and trying to reposition. Auto Heavy Credit Union placed in conservatorship as consumer credit quality deteriorates. So the National Credit Union Administration placed a credit union into conservatorship for the first time in nearly a year as consumer loan quality continues to deteriorate. This was Atlanta-based First Choice Credit Union, which has $38.7 million in total assets, which makes it insanely tiny. But basically, I guess they're seeing some bad auto debt come through. Let's see what else we got here. U.S. Bank's net gains from loan sales surged to 2-year high. Okay, so U.S. Banks kicked off 2024 with the highest level of net gains from loan sales in 8 quarters. Loan sale activity has remained relatively muted since the Federal Reserve began raising interest rates in 2022. However, in the first quarter, the U.S. banking industry reported $1.69 billion in net gains on sales of loans and leases, up from $1.16 billion in the fourth quarter of 2023 and $995 million a year ago. The increase was largely due to mortgage and student loan sales. This trend is likely to extend into the second quarter as mortgage gain on sale margins continue firming and drive better earnings and mortgage originators and servicers. So that is something we need to keep a bigger eye on. So I've reported there basically that you've got this situation now where, private credit, hedge funds and private equity are buying these loans from banks. Banks can't wait to unload these loans because a lot of them are probably bad loans or things that are about to go bad. But the private equity and the hedge funds, they're buying these things because they're trying to keep that whole business that they started, back during the ZIRP and the QE era a few years back. They're trying to keep that rolling, and they're just trying to gobble up all these assets to keep that business growing there. I have a feeling that that's going to come back to bite them at some point, but we shall see. And then delinquency rate drops again for major credit card issuers. Consumers slow credit card spend. So the 6 biggest U.S. credit card issuers reported the 4th consecutive monthly drop in their group average 30-day plus delinquency rate, and executives from the companies noted that consumers are starting to spend more rationally. I just find this interesting because I keep seeing these articles here saying that, like, oh, well, the delinquency rate is dropping from the major credit card issuers. But then I go out and I see articles from like CNBC, Reuters, Bloomberg, basically saying that, almost 10% of credit cards are delinquent. So, which is it? There seems to be a little bit of a disconnect there. And I'm going to have to look in a little bit closer to see if we could figure out kind of what is the disconnect there. Like, why are some people saying that the delinquency rate is rising, but then the major credit card companies are like, oh no, the delinquency is actually going down. Consumers are spending a little less, a little more rationally. So it's just kind of interesting. And then finally, very quickly, I just wanted to bring in a couple of articles here. So this again has to do with interest rates and basically debt. So total debt hits new high for rated U.S. companies in the first quarter of 2024. So total U.S. corporate debt levels for companies rated by S&P Global Ratings climbed to a new high in the first quarter of 2024. Investment grade debt reached nearly $6.648 trillion in the quarter, up less than 1% from the $6.595 trillion a quarter earlier. So the debt is going up, and then I want to show you this real quick. So interest eats further into corporate profits in the first quarter of 2024. So interest payments are consuming a larger share of U.S. corporate earnings as benchmark rates remain higher for longer. So during the first quarter earnings, before interest and tax was able to cover debt interest payments 5.78 times for the median investment grade U.S. company, according to the latest S&P Global Market Intelligence data. This interest coverage ratio fell from a revised 6.08 ratio in the fourth quarter of 2023, marking the second straight quarter of declines for companies rated BBB minus and above by S&P Global Ratings. So again, what the quick takeaway from this here is that, there is a massive amount of corporate debt right now to the tune of $6.6 trillion. And that as the rates stay higher for longer, that is really beginning to eat into corporate profits as companies have to spend a lot more money to service this debt. They're also going to have to spend a lot more money to call what's rolling the debt. They have to roll this debt over every couple years. And that's costing them a lot more money. And, and we're also seeing bankruptcies, start to rise. Undoubtedly, there are some companies right now that when they have to roll their debt, they are not able to or cannot afford to do so. So just again, more stuff that we just have to keep an eye on as we go through here. So I will wrap up. Thank you so much for joining me again for another weekly update. I tremendously appreciate it. And if you like this episode, please make sure to like, share, and subscribe. That always helps the channel. Please make sure to check us out on YouTube, Rumble, and all major podcast platforms. Please make sure to leave your comments down below, as I always love getting back to people with their comments. And I will see everybody next week. I hope everyone has a wonderful, fantastic 4th of July. Stay safe out there. Hopefully shoot off some good fireworks. And I will see everybody again next week. And don't forget to go check out some of those other episodes. Thanks a lot.